Thank you for checking out Fieldman Rolapp Associates Municipal Market Update. The data is as of May 17th, 2024. The Municipal Market Update is our attempt to give our clients and other industry participants a general update on what we're seeing changing in the marketplace. For the most part, we provide very similar slides with just updated information. But when we find something new or a point that we want to illustrate, we oftentimes weave in new slides and really try to provide consistency from month to month for our clients to get a sense of how the municipal market has changed or not changed since they've last issued. Fieldman Rolapp Associates is a municipal advisor to government, and my name is Adam Bauer, and I serve as CEO and president of Fieldman Rolapp Associates. To just start, though, just want to give you a general sense of what's going on in the general finance scene before I dive into some of the data. First, which seems to be a very hot topic, is T+1. This is where instead of having stock trades take 2 days to settle, they now will take 1 day to settle. And a lot of the articles are suggesting that meme stocks and that kind of trading really has put some risk in the marketplace and potential default if that time frame isn't shortened, or at least by having it shortened, it decreases the chance of default. The other thing I would say is we are in our May 1st, we're in our sixth consecutive Fed meeting where they left rates unchanged. So I think that's really important. There was talk of having 6 rate cuts in 2024. I don't think anyone thinks that's true at this point. I'm not even sure if there's enough meetings to make that happen. Lastly, feels like we're all trying to move on from the pandemic or COVID, but the Fed chair came down with COVID last Thursday. Online search suggests he's 71 years old. So certainly someone that could be negatively impacted by having COVID. And it just feels like, I think with a lot of things, inflation, COVID, it's just so hard to get past that and be into kind of the way things were before COVID. So with that, let's dive into some of the numbers. And I've talked a lot about how rates were declining in 2024. We've seen a pullback up, but then I also have some data to show you where they actually started declining again. So let's walk through it. Here you go. I've already really given you this. This is a chart where we cram 3 things on one slide, which I think makes a compelling story if we're able to walk through it. So the bottom horizontal axis, we have dates. On the left vertical, we have the aggregate interest rate. And then on the far right, we have some rate changes. So if we start with the green bar go all the way to the right, and that will show you how much the Fed funds rates changed on each one of those dates. And so you see some pretty hefty rate changes there, 4 in a row at 75. So now go to the far left, and that yellow line corresponds to that. That is the aggregate accumulation of all the Fed fund rate increases or not. So you can see once that last one happened in July of 23, you can see it's just pretty much steady after that. But then what I also think is pretty compelling is to see how the 10-year Treasury was responding to all this. So you see it go up and down, but generally stay pretty level there if you try to draw a line in the middle of that since about December of 2022. Whereas before that, when you saw these steady, pretty large overnight Fed rate increases, you really saw that 10-year Treasury kind of ramping up along with that. So you can see the correlation here, but you see a lot more movement with the 10-year Treasury than you have with the Fed funds rates. When we started looking at this data when we started talking about inflation being transitory, we saw a really shift, and you've heard me talk about this if you watched the MMUs, on January 3rd of 2022. Transitory got dropped from inflation. Fed started talking about needing to look at some rate increases in March of 2022. They did, but then there was anticipation that it would happen. But that blue line with the green dots in it, the one on the bottom, that one was where the U.S. Treasury was at that point in time. But if you look at that green line, that's where the same data points are as of May 15th, 2024. So you see an inverted yield curve. You also probably see rates that are much higher. And so this is just kind of illustrating what took place from when I think the economic markets said, hey, transitory, maybe not, maybe it's just inflation, but then where rates are after having that time to absorb all that data. This slide. We walked through this. This is at a 30-year MMD. So then the MMD, municipal market data, AAA, that's the best credit you can have. And we're tracking how that 30-year MMD's changed over time. And so want you to look at, so when it says May 1 of 2023, that's looking at the last day of April of 2023. So it's kind of where things started at the beginning of the month. And so you can see that last one, May 1 of 2024, you can see that it was 28 basis points higher when the month started at 3.96. But I want to show you something. Keep March 1, 2024, 3.59 in your mind as I go to the next slide. Look at that far right there, that 30-year MMD. So this data is as of the 15th of May, where that data was as the first or the last day of the prior month. You can see just in the first 2 weeks of May, we've gone from the 30-year MMD being at 3.96, dropping down to 3.59. It's the column all the way to the far right there. So now that I've illustrated that point, just how much rates went up, and then they came back down. Hopefully they stay lower for all of our municipal market issuers. But let's talk about this slide for a moment. The blue bars represent the AAA MMD range of interest rates going back to 2005. Then that yellow line represents MMD as of 5/15/2024. And as a refresher, well, I've been talking about the 30-year MMD a lot through these slides. There's actually an MMD for years 1 through 30. So for each year, they have their own interest rate. That's what that yellow line represents. Blue lines represent the range of those lines going back to 2005. So once again, you see that inverted yield curve there for the first 13 years or so. Then it really is flat very much after that. So you can see the very front end of the yield curve, you can see rates are a little bit high. But then when you get out to where a good portion of where the debt is being sized and structured, you can see there we're probably just about average, kind of right there in the middle of those blue lines. So when you put some of this in perspective, I think it helps us all understand that while rates are higher than they were in the last 4 or 5 years, when you look at it on a longer time frame, they still are near the middle of the pack. A lot of data on here. I think we just really wanted to show you kind of how things have changed over time, how volume has changed, and how there's movements and different types of sales. Really, since I spent so much time on other things, I won't spend too much time on this slide this week or this month. If you have questions on this, feel free to email me at abauer@fieldman.com. Now, this is money moving in and out of funds, and funds are a very significant buyer of municipal bonds. So green money's flowing in, yellow money's flowing out, and this is the demand for bonds. This is a supply. So you've heard a lot about supply and demand. So we have a lot of, when I say we have a lot of issuances right now. So when you look at these lines, whether yellow, green, or dotted there, those are some historical averages. And at every other recording I've done in 2024, I've talked about volume being low. And that is one reason why rates were held down, was because there was still demand for bonds, but there wasn't that much of them available. This may be testing that. It'll be interesting to see what happens over time here. But we are having a significant amount of issuance above the averages we've seen in recent years. And so this is something to watch. When I do this recording in June, it'll be interesting to see where this shakes out, and it'll be interesting to see how it impacts interest rates. Here's the economic data that's on the horizon. Encourage all parties to take a look at this. Should any of these numbers come in in an unexpected fashion, rates will likely be impacted by that. Here we just show you some of the AAA and their callable yields and how they compare to each other over time. Once again, if you have more questions on this, feel free to reach out to me. I want to thank our team who really helps put this together. Jason Chung, who's listed on here and is a resource to all of you. He's been a real big help on this, but I also want to make sure I thank 2 people that are not on here, and that is Michelle Seabrook, who gets us posted, works with an outside vendor to do that, but also Cynthia Overis, who prepares this on a monthly basis and makes sure that we have great data for you. So for May, I want to say thank you for your time. Look forward to talking with you again in June. And if you have any questions in the meantime, please feel free to reach out to me.